If you're still looking for the next AI software winner, you're looking in the rearview mirror. The biggest bottleneck for AI isn't code anymore. It's the physical world. It's energy, it's hardware, and it's national defense. Today, we're showing you how to profit from the physical wall AI just hit. In this episode, we'll be breaking down the next Nvidia contenders like Symbiotic and Applied Materials, and why energy giants like Constellation Energy and Taiwan Semi are the only reason AI can even function. Then we'll discuss AI in the defense sector, where we'll uncover exciting names like Ondas Holding, Mobilicom, Optical Systems, and Skyplay. Some of these are trading below the $10 mark. Finally, we'll wrap up with our three favorite stocks to own right now. So make sure to stick around until the end.
Okay, let's unpack this because right now in the skies over Ukraine, you have these cheap plastic drones powered by like localized artificial intelligence,
Oh, yeah,
right?
totally.
And they are completely rewriting the rules of modern warfare. I mean, they're making these traditional multi-million-dollar defense systems look practically obsolete.
It's wild to see it playing out in real time.
It really is. And meanwhile, back in the U.S., you have Microsoft literally signing contracts to buy power from physical nuclear reactors just to keep their AI systems awake.
Right, which just shatters this whole idea of what a tech stock even is anymore.
Exactly. The definition is just, well, it's gone.
Yeah, I mean, it is this profound paradigm shift. We're moving away from that era where investing in tech just meant, buying a software company with a lot of user growth.
Just looking at daily active users on an app, right?
Exactly. Now, the physical constraints of the real world are suddenly the biggest bottlenecks for AI. We're staring at this landscape where the lines between software, heavy industrial hardware, energy grids, and national defense are just entirely blurred.
Which is exactly why we are going on a massive custom-built deep dive today. And it's specifically for you listening, because we're looking at this towering stack of sources covering 11 different technology and AI stocks.
It's a lot of material to get through, honestly.
Well, it's huge. And we're going to break them down into three distinct buckets. So first, we've got these cheap tech plays under $10 that are kind of like the invisible plumbing of the internet.
Love those hidden gems.
Right. Then we have the hyper-growth candidates operating in the physical world. These are the ones angling to be the foundational layers for the next decade.
The next Nvidia contenders, basically.
Yep, exactly. And finally, we're looking at the high-stakes, intensely evolving world of AI defense upstarts, the next Palantir-type companies.
Yeah, and our mission today is really to sift through all of this. We're going to explore these 11 companies, dissect the physical mechanisms behind them, look at their economic moats, and critically examine the real execution risks.
Because there are always risks, especially with geopolitics right now.
Oh, absolutely. And ultimately, we want to distill this massive list down to our top 3 favorite companies and explain exactly why we like them best.
But before we take a single step forward into all that analysis, we really need to lay down a crucial ground rule for this conversation.
Yes, we definitely do. We need to be crystal clear with you listening. This is purely a friendly discussion for educational purposes.
Purely educational.
Right. We are just analyzing the provided source material to understand the mechanics of these businesses. This is absolutely not financial advice.
None of it.
Investing involves significant risk, especially in these highly volatile sectors like early-stage AI or small-cap defense startups. Anyone looking at these concepts really must do their own thorough due diligence.
Perfectly said. So to understand where AI is going, I think we have to start at the absolute microscopic foundation.
The physics layer.
Yes, because before an AI can, write code or generate a funny image or fly a drone, it has to physically exist on a tiny piece of silicon.
Right. It's fundamentally a material science problem at the base level.
Exactly. And that brings us to Applied Materials, ticker AMAT.
Yeah, so Applied Materials is super interesting because they occupy this really unique space in the ecosystem. They don't actually design the AI chips.
They aren't the ones making the blueprints.
Exactly. They aren't competing with Nvidia or AMD. What they do is they engineer and build the multi-million-dollar, highly complex machinery that actually manufactures those chips.
Okay, so let me give an analogy for the listener. Think of Nvidia as the architect who draws up this brilliant blueprint for a massive Lego tower, right?
Okay. I like this.
And Taiwan Semiconductor, TSM, is the master builder snapping all the pieces together. Applied Materials is the chemical engineering company inventing the specific type of indestructible plastic and the little interlocking snaps that allow those Legos to hold together under extreme stress in the first place.
That is a brilliant way to look at it, because their intellectual property moat is just staggering. I mean, they hold over 22,000 patents across the wafer fabrication market.
22,000, that's insane.
It is. And they reinvest roughly 10% of their massive revenue stream strictly back into R&D. The physics involved here are genuinely mind-bending.
Well, the sources actually highlight this specific breakthrough from AMAT called let me get this right, the Enhanced Black Diamond Low Dielectric.
Yes, the low dielectric film. To understand why that matters, you have to realize the physical limit we're hitting with silicon right now.
Right, because we're cramming billions of transistors onto a chip the size of a postage stamp. It's not even electrical engineering anymore.
Oh, you're literally fighting against quantum mechanics at this point.
Right.
As these microscopic wires get packed closer and closer together to increase processing speed, you're operating at the atomic scale.
And at that scale, things get weird, right?
Very weird. Electrons moving down one microscopic copper wire will naturally want to jump or kind of magnetically interfere with the electrons in the neighboring wire.
Which creates a short circuit.
Basically, yeah. It creates signal loss, massive heat generation, and microscopic shorts. So you can design the smartest chip in the world, but if the electrons bleed across the wires, the whole thing fails.
So what does this black diamond stuff actually do?
Well, AMAT engineered this new proprietary chemical vapor deposition process to create this film. It essentially acts as the ultimate quantum guardrail.
Oh, wow.
Yeah, it allows the chip manufacturers to place these microscopic wires closer together than ever before without that electrical interference.
So they are actively solving the fundamental physics problems that threaten to kill Moore's law.
Precisely. They are the ones allowing companies like Nvidia to keep pushing out these faster architectures.
But the sources also mentioned this incredible, feedback loop happening internally at AMAT. They were actually using AI to invent these new materials.
It's a total virtuous cycle. They deploy advanced machine learning models to simulate how different atomic structures are going to behave under extreme manufacturing conditions.
Which has to save them so much time.
Oh, drastically reduces the time it takes to invent a new material. So they use AI to invent better materials, which allow the foundries to build better AI chips.
Which are then used to run even more complex AI models to invent the next generation of materials. It's wild.
It really is.
But here's my question. If they are this foundational, literally the physical base layer of the entire revolution, generating, I think, $2 billion in profit in a single quarter, why isn't the stock exploding like Nvidia?
That is the big question. And the drag on AMAT is really tied heavily to macro geopolitics.
Ah, right.
Their balance sheet is pristine, the tech is amazing, but they are severely exposed to international trade tensions.
Because the U.S. government views advanced chip manufacturing is a massive national security issue.
Exactly. And they've placed these really strict export restrictions on advanced chip-making equipment going to China.
Which effectively cuts AMAT off from one of the largest manufacturing markets on the planet.
Yeah, and it's not a theoretical hit. AMAT's own leadership has projected that these specific U.S. export restrictions will cost the company roughly $600 million in lost revenue by 2026.
Wow. 600 million.
Yeah, you have this brilliantly run company acting as the anchor for global tech, but they are dragging a $600 million geopolitical weight behind them.
And the market hates uncertainty.
The market absolutely despises uncertainty. The U.S.-China trade war introduces this massive variable that AMAT's management just cannot control.
Okay, so that frames the physical layer perfectly. AMAT invents the materials and the machines. But someone actually has to buy those machines, build the massive clean rooms, and print the physical chips.
Right, which leads us directly to the builder in your Lego analogy.
Taiwan Semiconductor Manufacturing, TSM.
TSM is just the undisputed heavyweight champion of the foundry model.
I mean, the vast majority of the high-end AI chips sitting in data centers right now, whether the blueprint was drawn by Nvidia, Apple, Google, whatever, they were physically manufactured inside a TSM facility.
Yeah, they control roughly 70% of the advanced foundry market right now.
70%. That is practically a monopoly in the most critical hardware sector on Earth. And I saw their revenue grew 30% last year alone.
It's staggering. But looking at the sources, their future growth isn't just about printing more of the same flat chips.
Right, they're shifting toward this concept they coined, Foundry 2.0.
Yeah, Foundry 2.0. And they may have popularized that term partly to ease antitrust concerns by kind of redefining their total addressable market.
Oh, that's clever. Like, we don't have a monopoly. We're in a whole new market now.
Exactly. But it also represents a very real, incredibly difficult technological leap, heavily focused on advanced packaging.
Advanced packaging. Break that down for us.
So for decades, chip manufacturing was about printing smaller and smaller transistors on a flat, two-dimensional piece of silicon.
Right.
But we've largely hit the physical floor of how small we can print in 2D.
So if you can't build outward, you have to build upward, like Manhattan real estate.
That is the perfect analogy. Advanced packaging is the intricate science of stacking different chip components like logic units, memory, power management in 3 dimensions.
And then connecting them vertically.
Exactly, using these microscopic pathways called through-silicon vias. It allows for vastly superior data transfer speeds and energy efficiency because the memory is sitting directly on top of the processor rather than across the motherboard.
But doing that without the entire 3D stack melting from the concentrated heat has to be incredibly difficult.
It requires a microscopic precision that very few companies on Earth can achieve at scale. And this advanced sector of the market is growing at 20% annually.
Wow.
Right now, 60% of TSM's entire wafer revenue is derived from these highly complex, advanced manufacturing processes.
So they aren't just dominating the legacy market, they are dominating the hardest, fastest growing segment of the future market.
Yeah, it makes complete sense why Nvidia's CEO called them an all-time great company.
But, and there's always a but, if you control 70% of the global supply of the most important resource of the 21st century, governments and competitors are going to come for you.
Oh, the risks facing TSM are existential, and they are heavily funded.
The first is obviously geographical, right?
Yes, they are headquartered and do the vast majority of their advanced manufacturing in Taiwan.
Which is the absolute epicenter of geopolitical tension between the U.S. and China.
Right. If supply chains in the Taiwan Strait are disrupted by military action or a blockade, the global technology economy essentially stops functioning.
Which triggers the second massive risk, I guess, because the U.S. and Europe realized how terrifyingly vulnerable they are, so they are throwing sovereign wealth at TSM's competitors to build local factories.
Nation-state-backed competition is a huge threat. The U.S. government is heavily subsidizing Intel through the CHIP PS Act to build foundries in Ohio and Arizona.
Even Nvidia just directed a $5 billion investment toward Intel's foundry business, right?
Yes, and that is a clear strategic move by Nvidia to hedge their bets, create a second supplier, and gain some leverage over TSM's pricing power.
Samsung is also aggressively expanding its advanced packaging in South Korea and the U.S.
So TSM has the deepest technological moat in the world right now, but sovereign nations are actively trying to dig a competing moat right next door.
It's wild. Okay, so we have the quantum materials from AMAT and the 3D printed silicon brains from TSM, but a massive rack of AI servers sitting in a data center is just a very expensive paperweight if you can't plug it in.
Exactly. Which brings us to the ultimate bottleneck of the whole AI boom energy generation.
Specifically constellation energy, ticker CEG.
Right. And this connects directly back to that quote from OpenAI's Sam Waltman, where he noted that AI is fundamentally becoming a proxy for energy.
Because it takes a staggering amount of electricity to train a massive large language model.
And an equally massive amount to run the inference queries when millions of people are actually using it every day.
So how do we evaluate CG through that lens?
Well, you have to look at it through what Charlie Munger called the second-order effect.
Okay, tell me more about that.
The first-order effect of the AI revolution is the software, the massive valuations of companies designing the algorithms.
Right.
The second-order effect, the physical consequence, is that baseline electrical demand is suddenly skyrocketing after remaining relatively flat for nearly 2 decades in the U.S.
Oh, that's fascinating. So you don't necessarily need to pick the winning software model. You just need to invest in the resource that the winner will inevitably consume.
Exactly. And Constellation Energy happens to be the largest producer of carbon-free electricity in the United States, anchored heavily by their fleet of nuclear power plants.
Okay, but why nuclear? Why aren't companies like Google and Meta just building giant solar farms next to their data centers?
It comes down to the physics of the electrical grid and the operational requirements of a data center.
Right, because tech giants have made these very public carbon-neutral pledges.
Right. They can't power gigawatt-scale data centers by burning coal or natural gas without violating their own mandates. Solar and wind are great, but they suffer from intermittency. The sun sets, the wind dies down.
And you cannot have an AI data center training a trillion-parameter model suddenly power down at 8 p.m. because it got cloudy.
Exactly. Data centers require baseload power, a massive, uninterrupted, utterly stable flow of electricity 24 hours a day.
And nuclear is the answer for that.
Nuclear fission is currently the only carbon-free energy source capable of providing hyper-reliable baseload power at that scale.
And we're seeing the tech giants explicitly recognize this. The sources highlight that Constellation Energy just finalized a 20-year power purchase agreement with Microsoft.
20 years. Microsoft is legally locking in 2 decades of nuclear power just to ensure their future AI infrastructure has a dedicated heartbeat.
That is a massive proof of concept. But what's the downside?
Well, the financial setup for Constellation is compelling because they operate existing infrastructure. The headwind they face is entirely rooted in public perception and regulatory friction.
Right. Decades of pop culture, Chernobyl, Fukushima. There is a visceral, negative psychological reaction to the word nuclear.
Despite the fact that modern nuclear energy is statistically on par with wind and solar in terms of overall safety.
But the stigma remains.
Deeply, which makes building new nuclear reactors incredibly slow, heavily litigated, and astronomically expensive.
But wait, from an investment perspective, wouldn't that regulatory nightmare actually act as an ironclad barrier to entry?
Yes, you nailed it. No startup can easily build a competing nuclear plant to undercut Constellation.
So their existing fleet becomes an incredibly scarce, highly lucrative asset.
Precisely.
Okay, so we've built the foundational layer. We have the physics from AMAT, the hardware from TSM, and the baseload power from Seiko. But an AI sitting inside a data center is entirely digital. It lacks physical agency. How does that massive computational power actually translate into moving goods, optimizing fleets, and interacting with the friction of the real world?
Well, that transition requires robotics and advanced sensor networks. It moves us into the physical realm.
Which brings us to Section 2, AI in motion. And the most impressive example of this in the sources is Symbotic, ticker SYM.
Oh, Symbotic is fascinating. They operate in the autonomous warehouse and logistics space.
And we aren't talking about small experimental pilot programs with a few robot dogs here.
Yeah.
They are deploying infrastructure at a scale that generates over $1 billion in annual revenue.
Yeah, over $1 billion. And the technological hurdle they are overcoming is the inherent messiness of reality.
What do you mean by messiness?
Well, for decades, the golden rule in industrial robotics was strict environmental control. Like a robotic arm on an automotive assembly line is incredibly precise, but it's entirely rigid.
Right. It can weld a car door perfectly 10,000 times.
But if the chassis is misaligned by a single inch, the robot blindly welds thin air or crushes the door.
Because it doesn't actually understand what a car door is. It just understands spatial coordinates.
Exactly. Tasks that a human toddler can do instinctively, like looking at a jumbled bin of random items, recognizing a specific box, and reaching in to grab it at a weird angle, are computationally devastating for traditional robotics.
Right. The real world introduces infinite, unpredictable variables. So how is Symbotic solving that?
By integrating the absolute cutting edge of multimodal AI directly into their hardware. The sources point out they're using Nvidia's Jetson Thor platform.
Which isn't just a standard chip, right?
No, it's specifically engineered for physical AI and real-time kinematic reasoning. It allows the robot to process visual data, recognize unexpected variables like a fallen box, and recalculate its physical trajectory in milliseconds.
And they're also integrating with Google Gemini's advanced task models.
Yes, so instead of a human engineer writing 10,000 lines of code to teach a robot how to handle a new package, the AI can ingest the parameters and autonomously figure out the best way to move it.
That's incredible. And the way they deploy this in the real world is so cool. They install what they call a transfer deck.
The transfer deck is a brilliant structural solution. Rather than trying to design a robot that can safely navigate around unpredictable human workers on a crowded warehouse floor, Symbotic retrofits the facility to include a massive machine-only structural layer.
It's essentially a multi-story, high-speed highway system built inside the warehouse.
Exactly. No humans allowed. It's a highly coordinated, densely packed ecosystem of autonomous robotic vehicles moving vertically and horizontally at high speeds.
Wow.
It mathematically solves the traveling salesman problem in real time across millions of individual items.
And the economic moat that creates has to be massive. I mean, if a major retailer guts their distribution center and installs a Symbotic transfer deck, they're fundamentally altering their supply chain DNA.
The switching costs are enormous. The disruption required to rip that out and install a competitor's system creates deep vendor lock-in.
And the demand is staggering. The sources note Symbotic has accumulated a $23 billion backlog of orders.
23 billion. That backlog is the core of their valuation narrative, and it's heavily anchored by a $500 million deployment contract with Walmart.
But wait, let me push back on that. A $23 billion backlog looks incredible on a pitch deck, but isn't that pure execution risk?
It absolutely is.
I mean, if Symbotic installs this hyper-complex system for Walmart and a software bug causes the transfer deck to bottleneck during Black Friday,
Yeah.
the entire company tanks overnight, right?
Execution risk is the single largest vulnerability facing Symbotic. The tech can't just work in a simulation, it has to perform flawlessly under the extreme stress of peak global retail demand.
And are they profitable?
Well, despite generating over $1 billion in revenue, they are not currently profitable on a GAAP basis. The capital expenditure required to manufacture the hardware, fund R&D, and physically install these massive systems is immense.
There's also some psychological baggage attached to the stock itself.
Right.
Regarding how they went public.
Yes, Symbotic went public via a SPAC, a special purpose acquisition company.
Ah, the dreaded SPACs.
Right. During the peak of the 2021 tech bubble, SPACs were heavily utilized by pre-revenue, speculative companies to bypass the scrutiny of a traditional IPO. When the bubble burst, most SPACs collapsed.
So even though Symbotic actually has $1 billion in real revenue and real robots moving real boxes, they still get painted with that speculative brush by institutional investors.
Exactly. The stigma lingers. And let's not ignore the competition. You have Amazon aggressively deploying proprietary robotics within their own closed ecosystem.
And well-funded startups backed by OpenAI trying to build general-purpose humanoid robots.
The logistics automation market is estimated to be worth over $300 billion globally. Symbotic has a massive first-mover advantage, but they are running a marathon with some of the best-funded engineering teams on the planet trying to catch them.
Okay, let's scale down the physical footprint a bit. We go from massive, multi-story robotic warehouses to our next company, Powerfleet, ticker AIoT.
AIoT, right. They are operating in the sub-$10 range, currently priced around $5 a share.
So what exactly is Powerfleet doing?
They operate in a sector often referred to as the AI of Things, or AIoT. They specialize in enterprise-grade Internet of Things technologies, focusing on advanced telematics and securing high-value industrial assets.
See, when people hear telematics, they usually just think of a GPS dot on a map showing where a delivery truck is.
Right, but modern telematics driven by AI is so much deeper than that. It's ingesting real-time data on engine temperature, harsh braking patterns, fuel efficiency, driver fatigue.
Even cargo refrigeration levels, right?
Yeah. Exactly. It's the process of harmonizing massive streams of physical data to generate predictive intelligence.
Predictive intelligence. Give me an example of how that works in practice.
Sure. So instead of reacting to a broken axle on a highway, the AI analyzes subtle vibration patterns over the last 1,000 miles and alerts the fleet manager to replace the part before it fails.
Oh, wow. Saving them costly downtime and potential accidents.
Exactly. And the sources indicate Powerfleet operates within a total addressable market exceeding $120 billion.
And they are definitely capturing market share. Looking at their financials, first quarter revenue climbed 38% year over year, hitting $104 million.
Which is solid growth.
But even more telling is their AI video bookings, using cameras connected to computer vision models that grew by 52% quarter over quarter.
And they achieved $1 million in annualized operational savings for their client base in a single quarter.
That tangible ROI is critical for enterprise software adoption. But they still have the growing pains of a scaling tech company, right?
Yes. They reported a net loss of 8 cents per share in the quarter, which was wider than analysts projected.
But the bigger headwind seems to be, well, a narrative issue. The term AI of Things kind of sounds like consultant buzzword bingo.
It really does, and that is a profound psychological hurdle for retail investors. When you evaluate Symbotic, the value proposition is visceral. You watch a video of a robot moving a pallet and immediately understand the labor savings.
Right, makes sense instantly.
With Powerfleet, you're investing in an invisible back-end software layer that harmonizes data architectures. It's abstract. It requires deeper analytical rigor for an investor to grasp how that invisible efficiency translates into profit margins.
Well, that concept of the invisible layer actually transitions us perfectly into our next section.
The sub-$10 plumbing plays.
Exactly. We are shifting from the physical movement of trucks and boxes to the digital networks that carry the lifeblood of the modern economy, our money and our data.
These companies lack the glamour of humanoid robots, but they are utterly foundational.
Let's start with Priority Technology Holdings, ticker PRTH. They are trading right around $7.13. What is the actual mechanism driving their business?
So Priority Technology is a US-based financial technology company, but they are not building consumer-facing apps like Venmo.
No peer-to-peer stuff.
Right. They specialize in B2B, business-to-business payment processing and banking solutions, primarily targeting small and medium-sized enterprises. The core of their offering is their proprietary Priority Commerce Engine.
Now, why does a business need a specialized engine? I mean, swiping a credit card for a coffee is instantaneous. Why is B2B so complex?
Because B2B transactions are rarely simple, instantaneous transfers. They involve complex net 30 or net 60-day payment terms, detailed invoicing architectures, escrow requirements.
Multi-party approvals, risk assessments?
Exactly. Historically, this involved massive amounts of manual reconciliation, paper checks, and legacy ACH bank transfers that take days to clear.
So what does Priority actually do to fix that?
Their platform uses advanced algorithms to streamline that entire lifecycle. It allows businesses to collect, store, and disperse capital with the speed and data clarity of a modern consumer app while maintaining enterprise-grade security.
And the volume they are processing translates into very strong numbers. They just reported Q2 earnings and beat expectations across the board.
EPS of 26 cents, beating estimates by 9 cents. Total revenue was nearly $240 million for the quarter.
They raised their full-year guidance too, projecting between $970 and $990 million. That's almost $1 billion in revenue.
Those metrics indicate a robust business model capturing real market share. But the primary weakness for Priority is the extreme volatility of their stock price.
Right. The sources highlighted that despite posting overall gains over a 12-month period, the stock had a massive 39% drop year-to-date at one point.
A 39% drawdown is a violent swing for a company operating in the relatively stable business of processing payments.
It really illustrates the inherent danger of small-cap tech stocks, doesn't it?
Completely. The underlying fundamentals can be performing exceptionally well, but due to lower trading volumes and heightened sensitivity to macroeconomic fears.
Like sudden shifts in interest rates or localized banking panics?
Exactly. The stock price can experience these massive irrational swings that just shake out investors who lack conviction.
Makes total sense. Okay, let's look at the actual physical highway that all of those digital payments travel across. We're talking about ADTRAN, ticker ADTN.
Trading around $9.15.
What's their core business?
ADTRAN provides open networking and communications equipment. They operate deeply within the broadband access and optical networking market.
So they engineer the physical hardware and the management software, like the fiber optic terminals, the 5G connectivity platforms.
The cloud routing systems, yes.
Well,
The stuff that telecommunications providers and governments use to build out high-speed internet infrastructure.
let's make this tangible for you listening. Think about it. The massive AI models we discussed earlier are useless if the data cannot reach the end user instantaneously.
Right.
The Priority Commerce Payment Engine fails if the data packets time out. None of the incredible advancements in cloud computing matter if the physical glass tubes connecting our cities cannot handle the data load.
And that data load is expanding exponentially. Optical networking is actually an incredible feat of physics.
Bending light, basically.
Yes, you are taking digital information, converting it into pulses of light, and firing it down a strand of glass, roughly the width of a human hair, across the bottom of the ocean.
It's basically magic.
It is. And to handle the AI data boom, companies like ADTRAN have to invent new ways to bend and multiplex that light.
Multiplexing, what is that?
It's essentially splitting a single beam into multiple distinct color frequencies so that one strand of glass can carry vastly more data simultaneously without laying new physical cables.
Oh, that's incredibly efficient.
Yeah.
And they are seeing the financial reward for that innovation. Their second quarter revenue climbed 17% year over year to $265 million.
And their specific optical networking solution segment grew by 22%. The market is clearly buying their hardware to upgrade the grid.
He seemed perfectly positioned to capitalize on this multi-year broadband upgrade cycle. But there's a critical weakness.
Their bottom line, their earnings per share for the quarter came in completely flat, exactly zero.
They are making $250 million in revenue, but practically none of it is translating to pure profit.
This is the structural reality of being an infrastructure hardware provider. It is highly capital intensive. To stay relevant, Adtran has to continuously pour massive amounts of capital back into manufacturing, supply chain logistics, and R&D.
So they generate consistent, vital revenue, but squeezing high-margin profitability out of that physical manufacturing process is just a relentless struggle compared to a software company. Okay, so broadband networks and secure fintech platforms secure our daily civilian economy. But what happens when you take the bleeding edge of AI, advanced robotics, and hyper-fast data networks, and apply them to securing national borders and protecting human life in active conflict zones?
The dynamic changes completely. We move from optimizing logistics to navigating the asymmetric economics of modern warfare.
Which brings us to Section 4, the defense sector. We are examining 4 sub-$10 defense stocks leveraging AI.
The broader market narrative here is the hunt for the next Palantir. Investors are desperately looking for early-stage companies whose proprietary AI will become embedded in the trillion-dollar global defense apparatus.
Let's begin with a company that possesses a truly profound humanitarian mission, Safe Pro Group, ticker SPAI.
They are trading around $7.50, and the stock is up nearly 95% year-to-date.
What exactly does Safe Pro do?
They specialize in advanced drone imagery analysis, specifically engineered for the detection of unexploded ordnance, cluster munitions, and landmines.
So they fly drones over battlefields to map out explosives.
Right. They recently completed an extensive training deployment with the Armed Forces of the Philippines, funded by the U.S. Department of State, showcasing their tech in dense jungle terrain.
But the scale of their real-world data collection in Ukraine is what's truly incredible. The sources detail that SafePro has analyzed over 1.78 million high-resolution drone images covering roughly 19,000 acres of active conflict zones.
Detecting a plastic landmine hidden in tall grass or buried under debris using an aerial camera is an exceptionally difficult computer vision problem. Traditional algorithms just struggle with the chaotic variables of a battlefield.
So how does SafePro's AI handle it?
It utilizes advanced pattern recognition, spectral anomaly detection, and machine learning models trained specifically on massive datasets of explosive remnants. It identifies these threats with a speed and accuracy that manual human analysis just cannot match.
And from that dataset in Ukraine, their AI successfully identified over 31,600 distinct explosive threats.
It's saving lives, straight up. But the truly brilliant part of their business model is the architecture of their Spotlight AI ecosystem.
Let's talk about that, because a high-end AI model usually requires massive cloud computing power, right? Which is useless if an electronic warfare jamming system takes down your internet connection in a war zone.
Exactly. SafePro solved this with a hybrid approach. They utilize a decentralized edge computing architecture. They deploy a spot node system.
What's a spot node?
It's ruggedized hardware that allows the AI analysis to run locally, right there in the field, in near real time, completely independent of internet connectivity.
That is brilliant. But then when connectivity is restored, the system syncs seamlessly with Amazon Web Services in the cloud, aggregating the field data and updating the central models.
It's the exact same dual-layered tactical to strategic advantage that made Palantir so indispensable to the intelligence community.
But when we shift from the technological brilliance to the actual balance sheet, we hit a massive reality check.
Yes. The financial reality of SafePro Group is that of an extremely early-stage, pre-commercialization startup.
In their most recent second quarter, they reported a total revenue of only $92,800.
Less than $100,000 for the entire quarter. And they burned through $1.91 million to achieve it.
Ouch. Why is the cash burn so high compared to revenue?
Well, management states that this cash burn is a deliberate strategic choice. They are prioritizing extensive in-field deployment and rigorous stress testing over chasing immediate, small-scale commercial sales.
So they're building deep relationships with sovereign militaries and the State Department, playing a massive long game.
Exactly. They are proving their tech works in the absolute harshest environments on Earth, banking on the premise that once it's validated, multi-million-dollar government procurement contracts will follow.
But for a retail investor, that level of continuous cash burn is terrifying. If those contracts are delayed by bureaucratic red tape, the company just runs out of oxygen.
It requires an incredibly high risk tolerance, which actually leads us to our next drone-centric company, one focused not on detection, but on kinetic deployment.
Ondas Holdings, ticker ONDS, trading around $9.91, up an astonishing 287% year-to-date.
Ondas operates a portfolio of subsidiaries, including American Robotics. They recently executed a major strategic move by acquiring 500 WASM drones from Rift Dynamics.
They are aggressively entering the U.S. defense market, but the word in the sources that completely redefines their strategy, and frankly modern warfare, is attritable.
Attritable, yes.
Yes.
Their CEO explicitly stated their goal is to supply mass affordable attritable drone systems.
Break that concept down for us because it's so important.
The concept of attritable assets is the most profound economic shift in military strategy since the end of the Cold War. For decades, the dominant model was based on exquisite, hyper-expensive platforms.
Like an F-35 fighter jet.
Exactly. You build a $100 million jet, and you build a massive logistical tail to protect it at all costs, because losing it is strategically devastating.
An attritable strategy completely inverts that logic.
Completely. Instead of one perfect jet, you deploy a swarm of 10,000 cheap autonomous drones.
And they are explicitly engineered to be inexpensive enough that commanders fully expect and financially accept that a large percentage of them will be destroyed.
Because it creates an unsustainable mathematical problem for the adversary.
Right. If an enemy has to fire a $2 million Patriot missile to shoot down a $20,000 drone,
the enemy will bankrupt themselves long before they run out of missiles. Ondas is positioning itself to be the mass manufacturer of that attritable swarm.
and to meet that kind of volume, they established a strategic partnership with a global manufacturer named Kitron.
Securing the physical capacity to scale production up to 20,000 drone units per month.
20,000 a month. And the momentum is translating to their top line. Their quarterly revenue jumped six-fold year over year to $6.3 million.
And crucially, they have secured a war chest of nearly $69 million in cash to fund this manufacturing scale-up.
But the vulnerability remains the sheer capital intensity of hardware. Scaling physical production from prototype to 20,000 units a month introduces massive supply chain risks.
Quality control hurdles, massive upfront capital requirements. If government procurement cycles slow down, or if a larger defense contractor undercuts their pricing, that $69 million will evaporate rapidly.
Hardware is unforgiving.
Very true. Which is why our next defense company operates one layer removed from the drones themselves. They focus strictly on the communication and control layer.
Mobilicom, ticker MOB, up 163% year to date.
If the future of warfare is thousands of autonomous and remote-controlled drones, the biggest vulnerability isn't necessarily getting shot down.
It's getting hacked.
Precisely. Mobilicom provides the cyber-secure connective tissue. They engineer ruggedized ground control stations like their Maxi Controller Pro and highly encrypted data links called Skyhopper.
In a modern conflict zone, the electromagnetic spectrum is as violently contested as the physical airspace.
Oh, adversaries deploy massive electronic warfare systems designed to jam signals, sever the connection between a drone and its operator, or hijack the data feed entirely.
Which is a nightmare scenario.
Absolutely. Mobilicom hardware and proprietary software protocols ensure that a human operator can maintain secure, uninterrupted, low-latency control over a robotic weapon system, even in a hostile electronic environment.
And their tech is being validated. The sources detail a massive recent win where Mobilicom is integrating their ground control stations with a leading Israeli defense contractor's remote control weapon systems.
That single integration resulted in a $1.6 million backlog.
To put that in perspective, that single order essentially matches Mobilicom's entire total revenue generated over the first 6 months of 2024.
It demonstrates the explosive revenue potential when their technology gets designed into a major defense platform.
But there's a massive bureaucratic bottleneck attached to that revenue, is there?
Always is with defense. The source points out that while the integration is successful, it is currently in the final testing stages and mandates the ultimate formal approval of Israel's Ministry of Defense before mass production can begin.
Regulatory dependency is the classic Achilles heel of defense investing. A company can have superior tech and a willing buyer, but if the geopolitical winds shift or a review board delays certification by 18 months,
that massive backlog remains locked on paper, generating zero actual cash flow.
Right. Finally, let's contrast these cash-burning, hypergrowth startups with our last company in the defense sector, Optex Systems Holdings, ticker OPXS.
Optex presents a radically different financial and operational profile.
I mean, the stock chart is stunning. They are up an eye-popping 2,733% all-time.
And unlike the drone software startups, they are highly profitable right now.
In their third quarter, they reported $1.51 million in net income, maintaining very healthy 14% profit margins. They just secured another $1.6 million order from General Dynamics.
So they are bringing in real cash.
But what exactly are they building?
Optex is a legacy manufacturer of highly advanced optical systems. They build the laser-protected periscopes, electronic sighting systems, and advanced vision blocks integrated into virtually every armored vehicle utilized by the U.S. Department of Defense.
Like the Abrams tank and the Stryker vehicle?
Yes.
Okay, laser-protected periscopes are undeniably vital for a tank crew to survive. But does this actually qualify as an AI stock? It feels like we've drifted into evaluating a traditional hardware supplier.
That is a vital distinction regarding market classification. Optex is not writing large language models. They aren't a pure-play AI software company like a Palantir.
So why are they in the AI defense thesis?
Because modern armored vehicles are rapidly transitioning into sensor-fused nodes on a digital network.
The AI inside the tank needs eyes.
Exactly. The AI processing target acquisition, threat analysis, and automated defensive countermeasures relies entirely on the fidelity of the visual data being ingested from the outside world.
And Optex provides the ruggedized, high-precision optical hardware necessary for the AI to see the battlefield clearly through smoke, lasers, and debris.
They are the essential sensory layer. However, you are entirely correct to distinguish their business model. Their risk profile is that of an established, profitable, slow and steady defense contractor,
Lacking the exponential, zero marginal cost software scalability of a true AI startup.
Exactly.
Okay, we have covered an incredible spectrum of technology today. From the quantum guardrails built by AMAT, to the massive nuclear reactors managed by Constellation, to Symbotic's robotic ballets, and the attritable drone swarms redefining global security.
It's a lot to process.
Yeah.
Which brings us to the culmination of our deep dive, the final verdict.
Yes. The mandate was to analyze these 11 companies and distill them down to our top 3 selections, based strictly on the strength of their economic moats, financial resilience, and actionable positioning within the AI ecosystem.
Let's start the filtration process by eliminating some incredibly strong contenders that just don't make the final cut today.
All right. So Applied Materials is a technological marvel. They are literally inventing the physics that allows AI to exist.
What?
But for me, that $600 million revenue hit from the U.S.-China export restrictions is just too heavy an anchor. The geopolitical risk is too deeply localized on their current balance sheet for them to be a top 3 pick right now.
I agree with that assessment completely. The macroeconomic variables surrounding AMAT introduce a level of near-term uncertainty that overrides their technological brilliance in a top 3 ranking.
Yeah.
How do you evaluate the defense sector?
Well, the narrative of finding the next Palantir is intoxicating. The technology being developed by Safe Pro and Ondas is objectively changing the world.
No doubt.
But from an investment perspective, companies pulling in under $100,000 a quarter while burning millions are simply too speculative. They're essentially venture capital bets trading on the public market.
The risk of running out of capital before securing a massive government contract is just too high.
And Optex, while beautifully profitable, lacks the exponential growth potential of a foundational AI platform. So for the top 3, the defense sector is out.
A sound analytical methodology. The risk-to-reward ratio in the small-cap defense sector currently demands a specialized, highly aggressive portfolio strategy.
Definitely. So let us move to the final selections. Do you want to champion our first top pick?
I will. I'm choosing Taiwan Semiconductor Manufacturing, TSM.
The undisputed master builder.
Despite the profound, undeniable geopolitical risks inherent in their Taiwan-based operations, TSM's economic and technological moat is currently unparalleled in the global economy.
The Foundry 2.0 stuff.
Yes. Their absolute dominance in the advanced packaging space means that they are insulated from the software wars. It doesn't matter if Nvidia's next architecture beats AMD or if Google designs a superior custom chip.
TSM is almost certainly going to manufacture the physical silicon for whoever wins.
Betting against TSM is, quite literally, betting against the physical realization of the artificial intelligence revolution. They are the indispensable bottleneck.
I love that reasoning. Okay, I'm going to champion our second pick, and it attacks that exact concept of indispensable bottlenecks from a completely different angle. Constellation Energy, CEG.
The infrastructure arbitrage.
Exactly.
Yeah.
To me, this is the ultimate backdoor AI investment. The AI software landscape is chaotic. Trying to predict which specific large language model will dominate the market in 5 years is incredibly difficult.
Nearly impossible.
But you don't have to guess the winner. All you have to believe is that AI usage will continue to scale exponentially, and therefore the entire sector will require an astronomical, continuous supply of clean baseload electricity.
Right, and the 20-year locked-in power agreement they just signed with Microsoft is the ultimate validation of their business model.
Big tech is desperate for massive-scale power, and Constellation owns the regulated, irreplicable nuclear fleet to sell it to them.
It's a brilliant second-order strategy that completely bypasses the hyper-volatile software hype cycle.
Okay, that brings us to our third and final selection, a company I believe we are in full agreement on.
We are. It's Symbotic, ticker SYM, the autonomous warehouse robotics company.
Yes. Why does Symbotic make the cut for you?
Symbotic represents the most compelling intersection of advanced AI application and massive total addressable market. They are actively attacking a $300 billion global logistics sector.
And they aren't selling a theoretical vision of what AI might do in 10 years. They're solving highly complex, chaotic physical problems today.
Exactly. The fact that they have secured a $23 billion backlog, anchored by a massive commitment from Walmart, proves that the largest, most ruthless supply chain operators on Earth trust Symbotic's AI to run their critical infrastructure.
The execution risk required to fulfill that backlog is significant, and their unprofitability must be monitored for sure.
But the vendor lock-in generated by physically integrating a proprietary machine-only transfer deck into a distribution center creates a defensive moat that is nearly impossible for competitors to breach once the system is operational.
So there is the verdict. TSM to build the physical brain, Constellation Energy to power it, and Symbotic to give it a body to organize the physical world.
And as a final critical reminder for you listening, these selections are analytical conclusions drawn strictly from synthesizing the provided source material and evaluating business models.
They are not a suggestion for your personal financial portfolio.
Absolutely not. As always, mandatory, rigorous due diligence is required before making any investment decisions.
We have covered an immense amount of territory today. We analyzed the quantum engineering required to keep electrons from jumping microscopic wires.
We examined the physics of generating gigawatts of clean baseload power.
We explored how multimodal AI translates digital logic into a robot folding shirts in a distribution center.
And we dissected how the economics of global security are being completely rewritten by cheap, autonomous drones over the battlefields of Ukraine.
The overarching narrative is really just how deeply and physically pervasive this technology has become. Artificial intelligence is no longer an abstract concept confined to a chat box on a screen.
It is bleeding into the physical infrastructure of reality itself.
Which leaves me with a final provocative thought for you to mull over as we wrap up this deep dive.
I think the real question is this. If artificial intelligence is now actively running the simulations to design the next generation of materials,
If it's dictating the massive expansion of our nuclear energy grid,
if it's flying autonomous, attritable drones in active combat and physically structuring the architecture of global supply chains, at what point does the label tech company become completely obsolete?
right? Because if you project this current trajectory out just a few years, any company, whether they pour concrete, ship boxes, or generate electricity, that isn't fundamentally operating as an AI company might not survive as a company at all.
It fundamentally forces you to rethink how you evaluate every single business on Earth. You can't just look at a traditional balance sheet anymore. You have to understand the entire interconnected ecosystem.
Absolutely fascinating stuff. Thank you for joining us on this massive deep dive. Keep questioning the consensus, keep digging deep into those sources, and we will catch you next time.